For generations, agricultural success has been judged by the scale of the harvest. A heavier crop and a higher stocking density serve as the standard indicators of a profitable operation. Pushing biological systems to their peak capacity often destroys net profitability. The cost required to sustain high-volume output frequently outpaces the revenue that production generates. Data from the Noble Research Institute contrasts two pecan orchards. The high-production model yields 1,450 pounds per acre. The profit-focused model yields 1,100 pounds per acre. Despite the lower volume, the financial outcome is different. The high-production orchard nets $341 per acre. The lower-yielding orchard nets $672 per acre. Attempting to extract that final margin of yield triggers the law of diminishing returns. It requires an exponential increase in inputs, extra fertilizer, additional labor, and increased machinery maintenance that erases the value of the additional crop. Pushing a field to its biological ceiling also physically stresses the system. This approach trades long-term soil health and future crop stability for short-term, volume-based metrics. This pecan data suggests that navigating volatile global markets requires moving past gross production metrics towards strictly data-driven financial precision. To address this, operators are shifting towards a unified dashboard of key performance indicators, an agribusiness matrix. Relying on a farm-wide gross revenue tax return creates enterprise opacity. A single positive year-end figure can mask severe operational losses occurring in specific sectors of the business. Managing a farm as a matrix of interlocking operational stages, from breeding to feeding to harvesting, allows for each segment to be audited independently. Global competition and sudden supply chain shocks make operational guesswork a significant financial liability. Constructing this agribusiness matrix provides a framework for insulating an operation from market volatility. The first two modules of this matrix track net profit per acre and the true cost of production. Calculating the true cost of production requires breaking the farm down into isolated enterprise budgets. In a cattle operation, this separates cow-calf operations from the stocker and feed yard stages. Evaluating these stages requires transfer pricing. This is the practice of selling products internally on paper from one stage of the farm to the next. To establish a cost basis at each step, a Texas A&M scenario shows the stocker enterprise purchasing a calf, logging a $1,230 transfer expense. This sets the internal break-even price at $141.74 per CWT. This isolated metric exposes hidden bleeds, revealing a $15.80 loss specifically within the stocker stage. Without rigorous transfer pricing, profitable enterprises can secretly subsidize the failures of inefficient ones. The next matrix modules focus on operational efficiency, feed conversion ratio, labor efficiency, and inventory turnover. Feed conversion ratio, or FCR, measures the exact mathematical amount of feed required to produce a single unit of livestock output. In livestock operations, maintaining a low FCR serves as a primary defense against spikes in external feed costs. A Texas A&M sensitivity analysis shows the impact of market shifts. A 13% increase in the price of corn, from $7.50 to $8.50 per bushel, spikes the feed cost of gain to $105 per hundredweight. Operators can bypass these commercial feed costs through alternative efficiency methods. Multi-species grazing, such as mixing cattle with goats, optimizes available dry matter utilization. Other critical metrics include labor efficiency, measuring output per worker hour, and inventory turnover. High yields are ineffective if the produce sits unutilized, tying up liquidity. Mastery of these efficiency metrics determines whether an operation survives an external supply shock or collapses under the weight of input dependencies. The final module of the matrix is the Soil Health Index. Soil health, which tracks pH, organic matter, and nutrient levels, functions as a leading financial indicator for the business. Data from the Boston Consulting Group analyzes Kansas winter wheat farmers as they transition to regenerative practices. This 10-year timeline maps the transition risk. Farmers typically face a 60% profit decline in the first 2 years due to temporary yield drops and seed costs. The long-term payoff is significant. Farmers see an overall profitability increase up to 120% over a decade. This profit jump is driven by input reduction. Healthier soils allow for a 50% reduction in fertilizer and up to 75% reduction in pesticides. Improved soil biology also creates crucial flash drought resilience, allowing pastures to continue growing when neighboring conventional fields fail. Ecological resilience is financially linked to operational resilience, improving the soil, lowering the long-term cost of production for the entire matrix. An integrated agribusiness matrix allows financial, operational, and ecological KPIs to inform one another in real time. We can run a stress test on this model. Imagine a scenario where global supply chains fracture, causing a sustained spike in the price of commercial feed and synthetic fertilizer. A volume-based farm would absorb financial losses while attempting to maintain its high output targets with expensive inputs. In the matrix-managed farm, a red alert on the input cost module triggers a strategic response. The farm leverages its soil health index and grazing management to shift its dependency away from commercial feed, maintaining a stable net profit. The objective of the dashboard is to engineer an agile system that automatically mitigates financial risk. In a hyper-competitive global agricultural environment, operational guesswork is a significant liability. Ultimately, the relentless, data-driven defense of the profit margin is exactly what defines long-term success in modern agribusiness.